Welcome back to another video. Today we're going to do a Amazon stock analysis. This is going to be part of the FANG valuation series where I'm going to look at all of the bigger tech companies which just reported Q1 earnings. Look at the drivers of the company going forward, do a valuation. Our models are going to be pretty in depth into how we break down the revenue. So stay throughout the video. It's going to be very informative on how we value the company with the DCF as well as a EV to EBITDA multiple of 5 years out. And so we do two different types of valuation. Stay throughout the video to see that. And at the end, I'll give my take on what I think about Amazon's current stock price. So in the latest quarter that they reported, this is their revenue segment breakdown. I find this helpful. I put up a pie chart to give you an understanding of how this company's revenue is broken down. Right now, you have 49% of the company coming from online stores. That is the inventory that Amazon holds and fulfills. So that is the highest segment of the entire group. They break it down 6 segments. That's the biggest driver. And then you have physical stores accounting for 4%. And we're going to go through each of these segments. You have third-party seller services. That's 22%. Subscription services. That's 7%. AWS. That is 12%. And then other is 6%. This makeup of the company is vastly different than 4 years ago, where you have online stores account for 61% of this company. So you have had a significant shift in how Amazon makes their revenue of this company. You've had other double, you've had AWS starting to take a little bit more bigger chunk of the revenue, and definitely you have third-party seller take up a larger portion of the revenue growth. So we're going to go through each one of these. Online stores, this is generally a low margin business for Amazon. It's their largest revenue segment of the 6, and Amazon pretty much holds the inventory for this. This is where Amazon has the inventory. They are the ones who, when you purchase an item, you see it sold by Amazon and ships from Amazon. In this category, you can see in 2020 that the whole broader landscape of e-commerce had a worldwide growth of 27%, and Amazon is a huge beneficiary of that. When you look at Amazon's e-commerce GMV share in the United States, this year it's expected to reach 50%. Whereas in 2017, that was 37%. So that means they're gaining share on their competitors. That's from Walmart, that's from eBay, and all these other marketplaces. So not only is the broader market growing, but they're getting a larger share in the United States, and they're also expanding rapidly in international markets as well. The second is physical stores. They purchased Whole Foods in 2017 for $13.7 billion. Now they have about 500 Whole Food locations, and they are starting to open Amazon Fresh physical stores. They have 15 of these. And from this table here, you can see that Amazon is growing their physical presence in brick and mortar. You can see that they have a total of 589 stores, 500 of which is Whole Foods, and they're growing their presence in physical brick and mortar as this complements their online business. The third-party seller services is a huge driver of Amazon. This is where Amazon is able to have third parties go on their platform and be able to have Amazon fulfill sellers' orders through their distribution centers. Amazon is able to then take a cut. You have to pay a fee to Amazon in order to sell on their platform, and this is a huge driver of Amazon for the last couple of years, and in my opinion, it's going to be a huge driver going forward. As of Q4 of 2020, that the total amount of GMV, I would say, of the company, you have 55% of this of the GMV, most of that is sold by third-party sellers. So that's going to be an increasingly bigger part of Amazon's role going forward, is looking at to their third-party sellers, where they are the ones having to deal with the inventory, and all Amazon has to worry about is to fulfill those orders and do customer service, some of the customer service, and take care of pretty much marketing of these products. This is a huge margin driver for Amazon. The fourth is subscription services. This is primarily Amazon Prime services. People pay a monthly fee or annual fee. You can see that of Q1 of 2021, they have almost 150 million Prime memberships. And these memberships include things where you can go and get, obviously the 2-day shipping is a huge reason for Prime, fast shipping. You can also use it for Whole Foods to get discounts. You can also have the Amazon Video, music services. This is all benefits that Amazon provides when you subscribe to their Prime membership. The fifth is AWS, Amazon Web Services. This is the highest contribution margin out of all of them. Huge contribution to the overall operating margin. They have about 32% of the cloud market right now. 32%. The second player is Microsoft Azure with 20%. And here you can see the overall growth of how cloud computing is going to grow in the United States to up to 2027. The other segment is also a huge, rapidly growing segment of Amazon. They have advertising is by far the hugest contributor in this segment. And this is when you see sponsored tags. So pretty much when people are selling on Amazon, you're able to see if people advertise for a particular keyword, they're able to see that listing first. And a lot of sellers who are looking to get their product out to the consumers, but they can't get a way to, they can't find a way to get that product out and seen by the user. They use Amazon advertising. That's going to be a sizable chunk of their business going forward, and trying to take market share from Google and Facebook. Also, logistics is a huge part. If they can further build out their logistics to compete with FedEx and UPS, that's going to be another huge part of the other segment. So, huge drivers of the company for us. I believe that AWS is the number one key part. Number two is advertising. And then number three is the third-party marketplace. Those are the huge margin drivers of this company going forward if they want to improve their operating margin. Right now, here in this chart, you can see that AWS, for example, their revenue from 2017 was roughly around $5 billion. And then now in the most recent quarter, they've already grown that revenue to $13.5 billion. So that is a huge driver of this company. So now we're going to do a valuation walkthrough of this company where I go through the Excel spreadsheet and you're able to see how I got the value of this company. So in this spreadsheet, it looks a lot of numbers, kind of intimidating, but I want to give you an understanding of how we model out this company going forward, as well as what we the assumptions in the valuation and what we get from those assumptions. So the best way to break down a company like this is you gotta do a top-down approach of the revenue segments. So that's why I talked about those segments. You have those 6 segments, and these are the past numbers of the company. For 2021 and I model it out for 5 years. I think that after 5 years, it's really hard to model a company after that mark. You can maybe get 2 to 3 years, 4 and 5 years, you're already stretching it out. But the way you model out these numbers is pretty much, one, you have to look at forecasts on a macro level of how big e-commerce is growing in worldwide, pretty much. And So for online stores, we have this company growing this year to 250 billion dollars. You can see it right here. Here is this is in millions. I should write here in millions. So you have this growth of the company here, 2021 online stores, and in 2025 I have modeled this out as a CAGR of 18%. Their current margin is really low margin for this type of business. I have their current margin at roughly break even to 1%, and my forecast is they probably can do maybe 3% with if they're able to efficiently run the online stores business. But it's been historically really low margin business for that. Here we have physical stores. Physical stores, they had a dip in revenue the last 2 years, and I think this will probably ramp up in the next couple of years, but I don't see this as a huge revenue driver or a segment driver of this company. I say that right now their current operating margin is probably negative 2 to 3%, and they can maybe break even by 2025. Third-party seller, this is a huge segment of this company. I have modeled this company out and growing it at 34% compounded annual growth. This, I think, is Amazon's biggest goal for their company, is to continue to allow third parties to take over part of their marketplace. This growth is going to continue, and I don't think it's too far-fetched for these numbers. 34%. Their current operating margin is around 13% on the third-party seller, and we believe it can probably grow to 15 to 17%. The way I get these operating margins is the blended model of 13 of they break down their operating margin as a whole for their online business as a whole. And so the blended margin, these margins is something that I have went in to calculate to find out what their operating margins are. They don't break down the operating margin for subscription services, so for Prime, as well as for the other category. These categories, I believe for Amazon Prime, really they are trying to drive subscription growth. I don't think they're really not making money off of that service. So I have it as a break even for 2025. All of this, AWS, they do give it out as 30%. I just say that they hold on to that 30% and then they grow at 25% CAGR. For the other category, you have pretty much, I say around 5% operating margin with their Amazon advertising business model, and that's going 28% CAGR. So these models are generally, I say the market is pretty much looking at a model similar to this. When I compare my 2021 and 2022 top line revenue growth and EPS numbers to what Wall Street is expecting, it's pretty much in line with what they're expecting. But having this revenue breakdown is very important, because if you want to model accurately, you have to look through the assumptions that you make, so you know what the assumptions that I am making in this model is. With this, you have cost of sales, fulfillment, marketing, G&A, these expenses. Now, there's two ways you can really model this out. One is you can do it on a percentage of revenue. You can look at their past percentage of revenue and try to use that as maybe an average of the last 3, 4, or 5 years to do that. Or you can do what I did, is you can look at the operating margins. Operating margins wise, you can calculate, okay, this revenue multiplied by a current operating margin forecast, do that. And ultimately, I see Amazon having a operating margin of the whole company around 10%. Right now, they are doing roughly around 5%. So this is a double in their operating margin in the next 4 years, pretty much. So with that in mind, their operating income that we have forecasted is around $115 billion. You have the interest expense and interest income that they will most likely generate with more income coming in. And we get a net income of roughly 98 billion to, let's make it around $100 billion. Now, from this, you can do two things. If you want to do it on a price to earnings, you can put a price to earnings multiple on that. I went to a EV to EBITDA multiple. I think that makes more sense in this case because Amazon's PE ratio has historically not been a good way to look at the company. If you look at their PE ratio, it's kind of out of whack because of how Amazon redeploys their capital into the company. They want to generate more growth in the company whenever they see fit. So we have a EV to EBITDA multiple of 15 times. That's generally what the market is for a company at that size. The multiple is eventually going to compress to where the market is. And this is shares outstanding. You get a price of $4,050. Now you have to remember, this price right here is based in 2025. So this is not the price that it should be as of today. That represents a CAGR of roughly 7.5%, roughly in line with where the market is. So this is the model for how I did it. I even went and did another type of valuation of a DCF where you discount the cash flows of the company going forward and bring it back to the value of it today. Here, I use the same revenue projections that I made the first 4 or 5 years. But then going forward, I say that Amazon is continuing to grow for the next 10 years before at some point the company has to grow at the pace of GDP, right? So after 10 years, the terminal value, let's say 2.5%, in line with the historical US GDP. And I get a value of $3,500. So the current stock price is right there at that price range. So that means that the market is pretty much priced Amazon correctly at where the price is right now. So I hope you found this going through this helpful. This is a more detailed approach of doing a DCF, doing a multiple EV to EBITDA multiple 5 years down the road, different ways that you can build out a valuation for a company, a mature company like Amazon. But I believe these numbers are pretty accurate based on looking at macro trends, how much Amazon is getting their share in each of these 6 segments. And also, so the top line I'm pretty confident on. On the expenses side, that is really, the company can really be changed. The valuation can really be changed based on how you look at their operating margins going in the future. I mean, a 1 to 2% operating margin for some of these segments is going to be a huge difference to Amazon's bottom line. So that you really have to look at your view of the company. I've looked at their past operating margins as well. It's roughly been around 5%, but obviously looking at the past isn't always a good indicator of what's going to happen in the future. So I hope you found that going through that helpful. In our opinion, we have a neutral rating on Amazon. I own Amazon through ETFs. I'm not going to say to not buy Amazon. I think there's a lot of growth areas that Amazon has with logistics, healthcare, in their other segment, advertising. These segments, if they're able to ramp those segments, the stock is going to run higher. But I think Amazon, based on my valuation, I really dug deep into the valuation model. I think that market is pricing Amazon correctly. And So I'm neutral on this company. I think it will perform with the general market with any tech ETF. I think it's going to be perform pretty well, but I have a neutral rating on this company. So I want to thank you guys for watching this video. Hopefully you found this helpful, going through that Excel spreadsheet, giving you guys my valuation, my take of this company. Please like the video if you can, haven't already. Share with others who are interested in investing to know how to value a mature company like Amazon. Subscribe if you haven't already. This is only the first out of at least 5 companies that we're going to go through in the FANG stock group, and more in-depth stock analysis from SPACs and to a company really mature like Amazon. And I want to give you the whole range of companies that we value. So I hope you found this helpful. Leave your comments down below what you think about Amazon going forward. I would love to hear what you have to say about Amazon, the FANG stocks in general, what you think about Amazon going into the future, and also the valuation that I had. Your opinion, I always listen to them, good or bad. I value your opinion, so leave in the comments down below what you guys think. I appreciate it. Thanks for watching to the end. You guys are the best, and I'll see you guys in the next one. Peace.